Do we risk a second spike in inflation? Folks, I really do think this is something that you and I should at least think about and discuss. When I look at what caused the first spike, there are a couple of things that I think are okay, and then a couple of things that I think you and I should look out for round two of an inflation spike. So let's get into the topics. Let's break down the details. Let's ask each other what we think. So first and foremost, goods supply chain. When I think about the goods supply chain and what we did to our economy, frankly, the world economy in 2020, it is hard for me to believe that we would be that stupid again. So I currently do not think, see, predict a supply chain snafu of stuff. We'll get into raw materials and commodities in a minute, but when I think about the goods, I don't see us going after the supply chain. That said, this needs to be mentioned. If we add tariffs for imports from foreign countries, that could act as a tax or an inflation on imported goods. Also, don't forget that they would likely retaliate and have tariffs going the other direction. So we certainly have some risks about imports and additional inflation. What about international trade? This is a big one. I think international trade could see some uncomfortable ease, if you will. I know that there are talks of tariffs. I know there are talks of building more manufacturing in the United States, which I think is a great thing. So international trade is something we will definitely have to watch out for round two of inflation. I want to give a special shout out to the YouTube channel Uneducated Economist. That uneducated economist has been warning us quite loudly that we are on the cusp of some lumber shortages. There's apparently a lot of curtailment, a lot of lumber yards or lumber mills, shutting down. And if we have any spike in demand for housing or building in general, we could see lumber prices shoot much, much higher. Now for the real question, at least that I have. What about services, aka labor? As you know, the U.S. economy is predominantly service-based. So what is going on with labor? We certainly see a drop in quits. We certainly see a drop in jolts. There's a lot of signs that the job market is softening. But what is going on under the current? Will we see 3, 4, 5% wage inflation? If that does happen, we will see a round two of inflation. Now, what about asset prices? Now, asset prices aren't in the calculations for CPI. For example, home prices. Home price is not in the CPI calculation. Owner's equivalent rent is. But what happens if you have asset inflation? Well, folks, there's this thing called the wealth effect. If asset owners feel wealthy, they are likely to increase consumption, they are likely to increase borrowing, and they too could be more demand on the economy and have a round two of spending or of inflation. And then the big elephant in the room, certainly the last 6 months or so, is federal spending. We're obviously 70 days, I think, out of an election, and it looks like both parties are ready to start spend. So will the federal government continue to outspend their traditional percentage and really start running more deficits and be a big problem? And of course, all around this, we have a Fed who has pretty much telegraphed rate cuts in 2024. More on that in a minute. But again, it does appear that the Fed could be lowering rates into potentially inflation 2.0. The big one for me to watch for is services and labor, as well as asset prices. Again, asset prices, you can do yourself a favor. Just look at what happened to Bitcoin on Friday. You get Jerome Powell at Jackson Hole being super dove, and I think Bitcoin jumped 6% in an afternoon. Folks, if that's Bitcoin, what happens to other hard assets like housing and stocks and other things? At this point, as far as interest rates go, it looks like the investors are pricing in a 100% chance of 3 rate cuts in 2024 and an 80% chance of 4. Let me know what you think in the comments below. There are 3 Fed meetings left. What is your rate cut expectations? Do you think they go 25, 25, 25? Do you think they maybe start with something bigger and go 50, 25, 25? Let me know in the comments below. I'm going to stick to my guns, and I'm going to go nothing in September, 50 in November, and 50 in December. So again, folks, I think they are going to skip September. I know. I'm the only person talking about it. But hey, if I get it right, I'll be a legend. And if I get it wrong, who cares? I'm wrong all the time. So we do get a inflation reading this Friday called PCE, Personal Consumption Expenditures. It's a big one. It could, frankly, derail my call for September. If PCE comes in light, lower than expected, you can count on a rate cut in September. However, I believe that PCE has a chance to go higher than last month. Now I ask you, if inflation is going up month on month and the Fed's job is to beat inflation, can they truly cut in September? I don't think so. We do have some interesting earnings coming out this week that we should all be paying attention to. First one up on Tuesday is Nordstrom's. We've seen a lot of retailers report. Many of the retailers have kind of acted like people are trading down, right? Target to Walmart, Walmart to Dollar Tree. Now Nordstrom. Are people trading down from Nordstrom's to Macy's? I don't know. We had Macy's report last week, and it was ugly. So Nordstrom's, what is going on there? How about on Wednesday, we've got the big one, NVIDIA, AI. What is going on with NVIDIA? Is Microsoft, Meta, and Google still buying? Have they reduced capital expenditures? I don't know. We will find out on Wednesday. We'll also get CrowdStrike. Remember CrowdStrike was in the news when they released that patch, and it basically made computers a brick. It'll be interesting to see what kind of revenue or expenses they incurred because of that fiasco. You'll also get, on Thursday, you'll get Dell. What is going on with PCs? Are we having another upgrade cycle? And Lululemon. Lululemon will be interesting, right? What is going on with the upper 20, 25% who are Lululemon consumers? Are they done? Are they trading down? What is going on there? All right, let's talk about some recession calls. Read some articles from an economist named Steve Hinkie. Steve Hinkie is saying that recession 2025 is all but in the cards. And then there is John Wolfenbarger, says that a painful recession could see stock prices fall 70%. What do you think, folks? Do you think recession comes and a stock crash of 70%? To that end, Goldman Sachs says any of these nasty recession calls are overblown. Goldman Sachs is basically saying, yes, a recession is possible, but the fact that it will be deep and dark is rather unlikely, again, according to Goldman. Let's talk a little bit about housing. Let's talk about new home sales and existing home sales because they are really showing you what's going on in the market. New home sales, new builders are matching the market. They are giving rate buy downs and building smaller homes. It is that combination that is allowing new homes to exceed expectations. Remember, they were up like 10% or something last week. While existing home sales are broken, the Federal Reserve, Jerome Powell and his team, broke the housing market. And when I say broke the housing market, that is existing home sales. The move-up buyer is dead. They're locked in. Until rates get to somewhere around 4.5%, the move-up market is just non-existent. We are going to start to see motivated sellers. Yes, folks, even in a market like this, we will still do 4 million or so transactions. Motivated sellers, death, divorce, tired landlord, job transfer, whatever. But we aren't going to get the traditional move-up buyer, which is a buyer and a seller. You're also starting to see expired listings. This is something I've been harping on. We have all seen inventory build all year. What most people don't realize is we are starting to see expired listings. If you listed in March, it is time for your listing to fall off after 6 months in September. So we should start to see expired listings and withdrawals grow as we head to later in the year. And let's not forget seasonality. We have entered the slow season. The slow season is ahead of us. Obviously, when you talk about housing, you can't go by without talking about the horrible affordability. How is this going to be fixed? Well, the Fed's going to give us one avenue, which is lower rates. We are hopefully going to see higher wages. Yes, for the last 6 or 9 months, wages have exceeded inflation. Thank goodness. Let's hope that continues. And then hopefully prices stay flat, if not go down slightly. Again, the only way to fix the broken housing market, in my opinion, is slow grind sideways. I know it's not fun. I know it's not sexy, but that is what I am thinking. Mark Zandi says that the Fed is on the path to get the funds rate to 3%. If you don't know what the funds rate is today, folks, it's 5.25 to 5.5. So by my math, in order for the Fed to get to 3% funds rate, we have to have 11 rate cuts. No, is that right? 9 rate cuts. My bad, 9 rate cuts. The question for you is, what happens if the funds rate is 3%? What is the 10-year note? What are mortgage rates? Again, the federal funds rate doesn't directly impact the 10-year or directly impact the mortgage rates, but you and I have to ask ourselves, if the Fed cuts 200 basis points, what happens to the 10-year? What happens to mortgage rates? And then lastly, folks, I want to give a special shout out to Ty, TYLG, our Friday host of the weekly wrap-up. He held a seller financing session that went for almost 90 minutes yesterday in school. Ty, you are amazing. I heard nothing but great feedback. I want to thank you for being a valuable member of the school community. Thanks for being a mentor, leader, and friend. I hope you guys have a wonderful day. We are at sea, and it's kind of overcast and yucky today. But hey, we're going to be in Greenland tomorrow. Take care. Later.